Hey everybody, Chris Englebert with Englebert Financial Advisers with the weekly QCast Rotella update. It is the first week in May, and like we do every first week of the month, we talk about our strategy, we do a little review, and boy, has there been a lot to talk about, especially in the month of April. Now we show this cartoon, which we always start out with, and it shows obviously CNBC, a well-known financial news network that a lot of people watch, and everybody's saying, hey, everything's okay, don't worry about what's up ahead. The one thing that we really want you to take away from this is that the major financial news networks are very sensationalizing when it comes to the news. So for example, recently we've had the market go up 900 points. We've had the Dow Jones Industrial go down 1,000 points. They trumpet this headline and they really get people concerned about what's happening, and that's how they get viewers going. But let's do a little review here, because we did have a tough month of April. The S&P 500 literally was down 8% in the month of April alone, one of the worst months we've had almost in the last 10 years. So we'll see what happens going forward. But let's talk about a little bit about why that happened. So about a week and a half ago, everybody was waiting for the FAANG stocks, Facebook, Apple, Amazon, Netflix, Google, NVIDIA, to report earnings. And they were a mixed bag as far as the earnings go. Well, what ended up happening was the S&P 500, which again, remember, is dominated by these large cap tech stocks. Fully almost 25% of the S&P 500 is dominated by the FAANG stocks. And this is something that we've been telling people is a reason why you've got to be very careful about indexing to the S&P 500, we believe, for the next couple of years. Well, when those earnings came out, they were a mixed bag, a tremendous amount of negative sentiment, which we'll talk about at the end of this video. And we saw the markets roll over to new yearly lows. Well, then just this week, we've gotten the May Federal Reserve meeting. There was a lot of whispers about how in order to curb inflation, they might have to shock the system by raising interest rates 75 basis points or 0.75% on the short end. Instead, the Fed announcement yesterday was that they raised interest rates by 0.5%. Now, is the Fed still behind the curve? Probably, maybe. But again, very much like March when we got some clarity, Fed raised by 0.5%. We had a huge short covering rally, only to be giving all of that back here in the recent last couple of days. So what does that mean going forward? Well, a couple of things. Let's take a look at the 10-year Treasury. We're seeing interest rates over 3%, printing 3.05%. Again, we think that the bond market represents a tremendous value at these levels. Whether or not we go another 0.25% higher is anybody's risk that we may have. But we're trying to tell people that if you look at the taxable equivalent yields of especially tax-free bonds, you're getting taxable equivalent yields somewhere north of 6.5% to 7%, which is a lot of value. So if you watch some of our previous videos, we've talked about extending your duration. We still think you have to extend your duration, which means moving money from money market funds or short-term bond funds to more intermediate term bond funds, especially tax-free, because again, we think there's value up here. Now, the other comment that we'd like to make is we'd like to talk about oil. Everyone's concerned about these inflation numbers, and rightly so, and a large contribution to that happens to be oil prices, which obviously spiked earlier in the year on the Russia-Ukraine war. We're trying to tell everybody there's a $25 to $30 war premium in the price of oil, and you can see that oil's come down pretty good, did pop up a little bit at the end of April, but we still believe that when this war premium comes out, you could see oil prices retreat, and that would help obviously with the inflation numbers. But let's talk about what investors are thinking right now. And we have a chart here that's put together by Dorsey Wright that tracks the AAII numbers. This is the American Association of Institutional Investors. Every week, about 1,000 institutional investors are surveyed as to whether they have positive or negative outlooks on the investment markets. You can see by my blue arrow on this chart, we are seeing levels of negative sentiment that we haven't seen since 1992. Only 15% of the institutional investors out there believe that the investment markets are going to do well over the next 6 to 9 months. So what happens is we use this as a contrary indicator. So if everybody's very bearish and negative, Typically, the surprise is on the upside. That's why these huge short covering rallies where the market explodes by 900 to 1,000 Dow points are not unusual. But we believe that this negative sentiment has lasted for such an extended period of time that it looks like a better investment environment for equities should be coming up soon. We'll see if it's going to be the month of May, because remember, April we were down 8% in 1 month. I would not be surprised that May and going through forward, we see some better numbers as far as the U.S. stock markets go. So in conclusion, the FAANG earnings were mixed. Again, we are pounding the table that you've got to examine your portfolio and make sure that you don't have an overweight in the FAANG stocks. And the S&P 500 index is one of those. Again, our thesis is that you need to be everywhere in the equity market except the S&P 500 because it is dominated by the FAANG stocks, which we think at best, will cause that index to go sideways the next couple of years. At worst, may cause it to underperform. We really like the small mid-cap space. We think those stocks are extremely undervalued at this point in time. And we think we're going back to the 80s where we had high energy prices, high inflation, and high interest rates, but that was a good decade for small mid-cap stocks. Fed raised by 0.5%. We'll see what they do at the next couple of meetings. The 10-year Treasury did get over 3%. It had been banging up against that at the end of April. It's now at 3.05 as of this recording. We'll see if it tops out in this area for the year. But again, the point that we're trying to make for the month of May is that there's tremendous negative investor sentiment out there, which can set up for a very good stock market sometime in the near future. So that's all we have for the strategy update for the month of May. We'll be back next week with another topic. We'll talk to you soon.